Imagine two people, both are 30 years old. Both earn $100,000 a year. One person buys a house because they've been told the same thing their entire life. Renting is throwing money away. The other keeps renting and invests the difference. 20 years later, you might assume the homeowner is automatically wealthier. But what if they're not? What if the house came with property taxes, insurance, repairs, maintenance, interest, and thousands of dollars in costs nobody mentioned before they signed the mortgage? What if the renter invested the money that would have disappeared into those costs? And what if, for some people, buying a house is one of the worst financial decisions they could ever make? Now, this doesn't mean buying a house is always bad. For some people, homeownership can be an incredible decision. But we're rarely taught the other side. We're taught that owning a home means you've made it, that renting means you're behind, that a mortgage is automatically an investment. And that's where people can get into trouble, because a house is not automatically a good investment. So before you spend hundreds of thousands of dollars on the biggest purchase of your life, here are 10 reasons you should seriously consider never buying a house. 1. A house can destroy your flexibility. Imagine getting an incredible job offer, better salary, better career, a completely new city. You want to take it, but there's a problem. You just bought a house. Now you can't simply pack your things and leave. First, you may have to sell, then you may have to find a buyer, pay a real estate agent, potentially make repairs, deal with closing costs, and if the market is down, you might not even be able to sell without losing money. Renting gives you something incredibly valuable: mobility. Your lease ends. You move. That's it. When you're young, building a career, changing jobs, starting businesses, or simply figuring out where you want to live, flexibility can be worth more than ownership. A house ties a large percentage of your financial life to one physical location, and sometimes that's exactly what you want. But sometimes it's a cage disguised as an achievement. 2. Your mortgage payment is not the real cost. This is where many buyers make a massive mistake. They look at a mortgage calculator. It says, your monthly payment is $2,500. Great. They think they can afford $2,500, so they buy the house. Then reality arrives. Property taxes, homeowners, insurance, maintenance, repairs, utilities, possibly HOA fees, maybe private mortgage insurance. Suddenly that $2,500 house costs $3,200 or $3,800 or more. And here's the dangerous part. Rent usually has a maximum monthly cost. Your house often doesn't. If the air conditioner breaks, you pay. If the roof leaks, you pay. If the plumbing fails, you pay. A $15,000 repair doesn't care whether you planned for it. The house doesn't send you an email saying, "Congratulations, you've owned me for 5 years. You are now financially safe." It sends you a broken furnace. This doesn't mean renters have no housing costs. Of course they do. But home ownership comes with unpredictable expenses that can completely change the financial equation. 3. You pay an incredible amount of interest. Let's say you buy a $500,000 house. You put 20% down, that's $100,000 up front. You borrow $400,000. Now imagine paying that mortgage over decades. Depending on your interest rate and loan terms, the total interest can become enormous. You may eventually pay hundreds of thousands of dollars simply for the privilege of borrowing the money. Think about that. Your $500,000 house can end up costing dramatically more than $500,000. And interest is money that doesn't build equity for you. It goes to the lender. Now again, this doesn't automatically mean renting is cheaper. The comparison depends on the numbers. But the phrase, "I'm building equity instead of throwing money away on rent," can be dangerously incomplete, because mortgage interest can also feel a lot like money leaving your pocket. especially in the early years of a mortgage. 4. You may be putting too much money into one asset. Imagine you have a $200,000 net worth and you put $120,000 into buying a house. Suddenly, most of your wealth is concentrated in one thing, one house, in one neighborhood, in one city. Your financial future now depends heavily on what happens to that local real estate market. That's concentration risk. Now compare that with investing money across thousands of companies through diversified investments. You don't depend on one street, one neighborhood, or one local housing market. Again, your home can absolutely be part of a healthy financial plan, but treating it as your entire investment strategy, that's different. A house gives you somewhere to live, but the money tied up inside it isn't always easy to access. You can't buy groceries with a kitchen. You can't pay your bills with a bedroom. And if you suddenly need cash, you may discover that being house rich and cash poor is a very uncomfortable position. 5. Houses don't always go up in value. The way people expect, we've all heard stories. My parents bought their house for $80,000 and now it's worth $800,000. Those stories are powerful, but they can create a dangerous assumption houses always go up. They don't. Real estate markets are local. Some areas grow rapidly, some stagnate, some decline. And even when your home's value increases, you still have to consider inflation. You have to consider property taxes, maintenance, insurance, interest, selling costs. Suppose you buy a house for $400,000. 20 years later, it's worth $600,000. Sounds fantastic. But if you spent $100,000 maintaining it, paid enormous interest, and faced selling costs, your actual financial gain may look very different from the headline number. The house may still have been worth buying, but simply looking at the purchase price and selling price doesn't tell the whole story. 6. The down payment has an opportunity cost. Let's say you have $100,000 saved. You could use it as a down payment, or you could invest some or all of it. Now, there is no universal answer here. Markets don't guarantee returns. Housing values don't guarantee returns either. But this is the question most people forget to ask. What else could this money do? That $100,000 could potentially remain invested for decades. At a hypothetical 8% annual return without adding another dollar, $100,000 could grow substantially over 30 years. Again, hypothetical, not guaranteed. But that's opportunity cost. Every major financial decision means giving up another possible use for your money. The down payment isn't just $100,000 toward a house. It's also $100,000 that can't currently be invested elsewhere. And that's a comparison worth making before you sign anything. 7. Buying a house can push you into lifestyle inflation. This one is psychological. You buy a house. Now you need furniture. Better furniture. Then you need to decorate. Then the backyard looks terrible. Then your neighbor remodels their kitchen. Now your kitchen looks old. Then comes the bigger TV, the new appliances, the landscaping, the upgrades. And before you realize what happened, you didn't just buy a house. You bought a machine that constantly asks for more money. A larger house often creates larger expenses. More space to furnish, more space to heat, more things to repair, and sometimes people buy more house than they actually need simply because the bank approves them for it. But being approved for a mortgage doesn't mean the house is financially comfortable. Banks calculate what you might be able to repay. They don't necessarily calculate how much freedom you want to keep. There's a huge difference. 8. Homeownership can make you cash poor. Imagine this. Your net worth is $700,000. Sounds impressive, but $600,000 of that is tied up in your home. Your bank account has $15,000. Your investments are small, and you lose your job. Are you wealthy? Technically, maybe. Do you feel wealthy? Probably not, because net worth and liquidity are different. Net worth is what you own minus what you owe. Liquidity is how easily you can access money. You need liquidity when life happens. Job loss, medical bills, family emergencies, unexpected opportunities. If most of your money is trapped inside your home, you may have a high net worth on paper, while having very little financial flexibility in real life. And financial flexibility is one of the most valuable things money can buy. 9. Renting can actually be the better financial decision. Let's finally destroy one of the biggest myths. Rent is not automatically wasted money. You pay for shelter. That's what rent does. When you pay for a hotel, you're not building equity. You're buying a place to stay. When you pay for internet, you're not building equity. You're paying for a service. Housing works similarly. And when you rent, you're often avoiding some costs that homeowners must absorb. Repairs, major maintenance, some insurance costs, the financial risk of a declining property value. The key question isn't, is renting throwing money away? The better question is, what is the total cost of renting compared with the total cost of owning in my situation? And then, what will you do with the difference? If you rent cheaply and spend everything you save, renting may not help you build wealth. But if you rent and consistently invest the difference, the story can become very different. That's why the smartest decision isn't always buy or rent. It's run your own numbers. 10. You might simply not want the responsibility. And honestly, this reason doesn't get enough attention. Maybe you don't want to fix things. Maybe you don't want to mow a lawn. Maybe you don't want to worry about roofs, pipes, appliances, property taxes, insurance premiums, contractors. Maybe you value the ability to call someone and say, the sink is broken, and then it's their problem. That's okay. You don't have to buy a house just because everyone else thinks you should. A house is not a personality upgrade. It's not proof that you've become a successful adult, and it certainly isn't a requirement for becoming wealthy. You can build wealth while renting. You can build wealth while owning. The financial instrument isn't the goal. The goal is the life it helps you create. So, should you never buy a house? Not necessarily. The title is deliberately provocative. For some people, buying a house can be an excellent decision, especially if you plan to stay for many years. You want stability, you can comfortably afford the total costs, you have an emergency fund, you're investing for retirement, and you're buying a home you actually want to live in, not just one you're hoping will make you rich. Because maybe that's the most important distinction. A home can be a wonderful place to put your life, your memories, your family, your future, but you should be careful about treating it like a guaranteed wealth-building machine. Before buying, ask yourself, can I afford the mortgage and the hidden costs? Can I handle a major repair without going into debt? Am I still saving and investing? Do I want to stay here long enough to justify the buying costs? Would I still buy this house if I knew it might not dramatically increase in value? And perhaps the biggest question of all, am I buying this house because it improves my life? Or because I think I'm supposed to? Because personal finance isn't about copying someone else's dream. Some people want a huge house. Others want the freedom to move every 2 years. Some people want a backyard. Others want to invest the difference and travel the world. Neither automatically wins. But blindly buying a house because you've been told that's what successful people do could cost you decades of freedom. A peaceful financial life isn't about owning the most impressive things. It's about keeping your expenses under control, your options open, and your money working toward a life you genuinely want. Maybe that life includes a house. Maybe it doesn't. But don't buy one until the numbers make sense. And the life makes sense too, because the biggest financial mistake isn't renting forever, and it isn't buying a house. The biggest mistake is spending hundreds of thousands of dollars on something you never truly understood. I'm Morgan Vowles. Build small, grow strong, live free, and I'll see you in the next video.